Today, we want to continue our discussions on the Japanese yen and the JGBs, but in reality, this is really talking about all the sovereign bonds. So in the last two videos, if you watch them, you know what we're facing, and it's not ending anytime soon. Everyone's calling Japan the canary in the coal mine because, they are the third largest economy. I think they have the third largest amount of bonds outstanding, but their debt ratio is 250% versus the US at 120%, and the Europeans around 100%. And so when you look at, the weak sister of the four sisters, it's Japan. So everyone's watching Japan. And the other thing I want to say is remember something. The central banks create facilities to address certain problems, right? Problems that cropped up. Silicon Valley Bank, we had BTFP, all right, the Bank Term Financial Financing Program. So what's going on in the world and how are we reacting to it as the central banks? The first thing here is the 10-year JGB, its volatility has hit a record high, greater than the great financial crisis, right? So we can say with some certainty that the market is highly stressed. And this then stresses all the other markets, but this one's first, all right? So let's go back over Japan's situation just for a few minutes. About a year and a half ago, they brought in UEDA, as their head of the BOJ. He's an academician. So he came in and he had an express view of raising the interest rates, tapering the buying of the JGBs, and, normalizing the financial structure of Japan after basically 23 years of suppressing interest rates. So where's the economy for Japan? Well, it grew at 0.7%, just less than 1%. Its inflation rate is 3.6%. Japan's short-term rates are 50 basis points. Now remember, they were 9 years, they were negative, so 50 was a great move for them, but still, it's only 50 basis points. So the real interest rate are highly negative. The 10 years, 150. The 30 years, like 320. Again, all negative interest rates, which causes volatility, or another way it's expressed is that the yen goes down. But we know that the US, under percent, in the negotiations, is trying to force Japan to increase the yen. We don't know what the real percent is, but we can see by what they're doing with the tariffs. I would imagine they're asking for somewhere between a 15 and a 20% increase in the yen. Goldman Sachs came out just yesterday saying that overall, against all the world's currencies, they believe on a value basis that they created that the dollar is around 15% overvalued, okay? So I'm assuming that in these discussions, percent is asking for somewhere between a 15 and 25% increase in the yen. So what does that mean to Japan? Well, they're only growing at 0.7. If their currency went up that far, they would go right into a recession instantly, I would say, okay? So Japan doesn't want any of the 25% tariffs, none, especially on the car industry. So you have a country with negative interest rate, 250% debt. It's growing very, very slowly, and their bonds now are going up in yield. How do they get out of that? Now, back in February, the Bank of Japan was already being urged by what they call market participants. Who are they? They're the banks in Japan and the insurers, the insurance companies, all right? Saying that, hey, you have to slow down this tapering, all right? And continue to do quote unquote QE, all right? So don't taper, do more QE. So you can see in the first sentence, they actually say the delicate balancing act facing the BOJ. What is the balancing act? Well, what are your interest rates? What's your inflation rate? How's the economy growing? You got the tariffs coming. You're an export nation, and your long end is out of control and the volatility is at an all-time high. Which ones do you do? okay? Now, the BOJ came out today and said, hey, look, against your pool collateral, we will give you dollars, all right? So you have to understand something here. The BOJ does not print dollars, okay? They can only print the yen. So then you say, well, they own all these treasuries. They could sell their treasuries and then buy their JGBs. But if they sell their treasuries, we, the US, would be extremely upset over that. I would say we would be absolutely crazed if they did that. So what is going on here? So I'm going to bring this back to the great financial crisis. Europe, the ECB, could not print dollars. All the transactions in the world are done with US dollars, most of them, all right? So during the great financial crisis, when all the European banks got in trouble, they had to pay off their debits, their leverage or whatever with dollars. And the ECB could not just give it to them. Like in America, we just, here, we'll give you the dollars. They can't do that. So we created a repo between the Federal Reserve and the ECB for $600 billion. We normally charge another country 50 basis points, but during the crisis, we loaded it down to 25 because the ECB charged 25 to the banks. They gave them the dollars, they paid off their debts. So that's how it came down. So when you look at this, that the BOJ does apply US dollars against pooled assets, pooled collateral, what do they mean by that? Pooled collateral is just different assets. You can have cash, securities, real estate, CMBS, it doesn't matter. Whatever you have, you can go to the BOJ and say, give me dollars. So what is the BOJ telling these people to do? Take the dollars, buy yen, and then go buy the long-term JGB. And you have to see, there has to be an agreement. We're not going to give you dollars for nothing. So, in my opinion, just my opinion, is that the BOJ and the Federal Reserve are working very closely together, and we're doing a repo with the BOJ so they can give dollars to their insurers and to their banks so they can sell them, buy the yen, and buy the long-term JGB. And then, just a few minutes ago, UIDA comes out and says, hey, I don't see any more rate increases unless the economy and prices improve. And so we're not going to do any more rate increases. You have to understand something. They're not growing fast enough, and he still raised those rates, right? Because he was here to normalize the Japanese financial structure. So what does this mean to us? This is what I think it means, all right? One, I think everyone realizes that Japan is the canary in the coal mine. Two, one of the great things that we had to control these things or to effectuate it was that you could sell your reserve currency and then take care of the problem, all right? Well, guess what? In this case, they actually can't sell their reserve currency because the United States, we ourselves are under attack on the long end, right? And so if they started selling their long bonds, it would hurt us. And the other thing is that the yen would go down and we want it to go up. You know, they have not stated, but if you can see what they're doing with the other countries, I would argue that Goldman Sachs came out the other day and said they believe against all the currencies, the dollar is about 15% overvalued, according to their calculation, all right? So let's say they're right. We'll just assume that for now. So then what happens is that they can't sell their holdings, which would then drive down the dollar, drive up the yen when the tariffs are hitting. Can't happen, right? So, in my opinion, we have created a facility, a repo facility with the BOJ so that we can start seeing if we can somehow slow down what's happening to the Japanese JGB long end. I don't know. What do you think? Like and follow and tell me in the comments what you think's going on. Thank you very much.